Do, do, do. Am I sharing my screen? All right, never know with Teams when the recording is starting. All right, guys. So what about this $900 gold? I'm going to try to tackle that like sub $900 gold. We've heard that, a few people mentioning that. And I'm going to tackle it not from a fundamental uncharted way, but from what the charts, looking at past behavior for charts where what needs to be, what weight of evidence you require to have that type of fall, and where does that fall land exactly in the weight of evidence. And I'm not even going to tackle, oh, is it a spike down on the intraday all the way to 900 and then it's going to bounce up and close much higher, which is one case, or is it going to be a slow grind down all the way to 900 and then a base for a long time around those areas and then climb back up. So I'm not going to look at those. I'm just going to look from a price action. Is it possible, or what are the odds? Because everything's possible, right? You can't go in that 100% or nothing, right? But what are actually the probabilities of that happening? So here I have the gold to in the yen, and this one's important because this is a case where when you think gold is always goes from bottom left to top right. Well, the yen is kind of spectacular because it did a spectacular move up in the 80s, and then it really went down for a while, guys. And look at that. So that corrected lower than what the US dollar gold chart did. The gold chart expressed in US dollars did, or most of them. This is quite impressive, creating this bullish descending, this bullish wedge, descending wedge, tightening. Look at that, beautiful. This was the opportunity of a lifetime. And look, the back test was completely violent, guys. We had a back test years later after this broke out, went sideways, but it was hitting some horizontal resistance. And then after that, it back tested it and then exploded upwards. But the point is here, look at the base it created. So this one did overshoot. Look, I don't have data in the 70s, the earlier 70s. I have this small halfway pattern, so it's kind of a base, but this is a true base. So 150 bars, 455 days, 55% move up, all that's a huge base. And here I extended the line just to show you that over time, the retraces after breakout of a huge base like that, 150, that's 150 divided by 12. I wish TradingView would put years here, have an option to see years. It'd be awesome. So that's a 12-year base. When you break out of a 12-year base, guys, it's meaningful. It's meaningful. It's something, a paradigm shift, all this energy on the way down. It got digested and then it's breaking out, and to fulfill its implied measured move, which is the beginning of a falling wedge. Once it's breaks out and then breaks out above the horizontal breakout line, its target is back up here. And what did it do? It did a perfect reverse symmetry move years later, guys, years later. So this thing about data not or resistance from a previous years not being important, or it's a myth, guys. It's a myth. All right, so here's 43-degree angle on the breakout line. Look at that, 43. There you go. So that breakout, the angle of entry and the base exploded outwards, and the target was reached even before in a timely manner. But I want to get back on track. So this is the base. The base exploded, went up. And after that, it did another consolidation base and it broke out. And this is a pretty big one also, 98 bars. So that's 98 divided by 12. That is an 8-year base. Those bases will not get easily overridden, guys. This, I'll keep showing you the evidence, but look at this. Once these breakout move out, you have strong moves, right? And this, somebody could have probably said, okay, here's a flag pull and I have a target up here. So here's we'll try to find evidence. And if you guys get to see these charts, spot huge, important 6-year, 8-year bases and show me one that it went back down below and hit a target below those bases. And I'll tell you, you will see when I keep the gold chart for last. you'll see why this is important. Here's sugar. Here, huge base. See this horizontal line never broke out above? That is, with this spike here, but that is a 300, that's a 10,000 day base, guys. And here, within that 10,000 day base was another 92 bars, 8 years, almost 8-year base, broke out. And here I have the dotted line. So this base here, once it exploded, yes, it could get retested from the top, but previous resistance becomes support, what I call a wall, right? So it becomes a pivot line. And look at that, seeps a little bit below, retests it, and then off it goes. And even over the years, even to today, that 8-year base has created important support for sugar. And years later, when you see that getting retested after a blow-off run, after a 10-year run, once you start hitting that, it's still meaningful. And these are giving you opportunities to play. And it bounces up, doesn't always go up, defining resistance, hitting that wall here. Then after that, bounce, creating another base. So that's 48 bars. That's 4-year base right here. But look at the price action. It never, after breaking above here, it never went down below that base. After this huge base broke out, it exploded. Yes, it went back within the base. It went about halfway, but it got halted on this smaller, closer base to the breakout, and it never went below that bigger base. And here's a fractal, same thing happening over a bigger base, and now a smaller base within a bigger base. Look, when this resolves upwards, you could almost say sayonara to hitting anything below this line here. It's that's what these bases are telling you. When they explode in one direction, they don't want to come back. Here is the same thing for, look, I'm going to maximize the screen. Can't believe I didn't do that. Here is the copper chart, huge base. And within that base, you have a smaller base, which is takeoff base, which create the reverse symmetry move to the previous hit. And if it closes above, then off it goes, guys. And look, this one here, that 73 months, never got even close because that bigger pattern, that 202, man, what's 202 divided by 12? 202 divided by 12, 16-year base. It got retested from above, which is fine. But to imagine that the price action is going to go below both of these bases here all the way down here is not going to happen. It could happen, but the probabilities right now very low. And we're going to keep looking at other charts, and eventually maybe we'll see a case where that happens. So here's another fractal or another analog move. Huge base for copper. Huge. So here is 149 months in progress. So until that line's closed above, that's still a possible pattern. And here you have a 77 months. So it's even bigger than this launch pad here. So this launch pad created the reverse symmetry move to give the price action another shot at hitting that resistance line. And yes, now it's valid. Now it broke down, going back down. Now it's retesting, just like it retested back in 2008. We were retesting from above. So this is a wall. Previous resistance turned support, testing it from above. So to expect the price of copper to go back below this formation here is tough. It's tough. It would be tougher if it would have broken out. Then reaching here would be even super duper tougher. But we do have this 8-year base right here, 7-year base, which makes it tough to imagine copper going back down below here. And going back all the way back down here, then that is far in the past. Here's platinum. And you'll see, guys, these charts, they all look alike. Here is 198 months. So many years. Here's a 100-month base within that bigger base, creating that dual support, right? Because a bigger base is support in line with a smaller base's inner, like a fractal within it. Once that breaks out, you see how you retest? Yes, you could seep through, but that line, after that, it held, price action bounced out. And when it closed above this one, now you have this wall, previous resistance turned support, and off it went. Even years later, as this thing was going down, see this low point here was not a low below even this line. It just managed just to seep just a little bit below this line, and it didn't go back down below this one here. Now, platinum, if I may, I'll just continue with this one. So now it's creating another bigger pattern. Don't know where that's going to land. We're going to probably have to wait until, just going to draw you some line, guys. Look, this was supposed to be a podcast about why gold cannot hit, or the probabilities of gold hitting 900, sub 900, or very low. And to do that, you need to find evidence through other charts in similar sector and see how their behavior, if they've shown evidence that that was possible, those type of retracements. And what I think is happening right now, this is another base within a bigger base, and I'm not quite sure maybe how low that is. So we'll have to wait to see on the bounce. But for that to go all the way back down here or very low below this line, very low, and maybe here. But yeah, because for that, once we close above the breakout base like we did here, then we could say that this is not going to happen. Then after that, you're playing above, right? You're going to be pulling back, maybe coming in within that pattern, but not all the way back down. So for platinum, it's still early. You need to wait until that breaks out to get more evidence. But for it to come all the way back down below this huge base, very, very doubtful. Okay, US oil. You'll see these things happening, playing over and over. 170-month bar base breaks out. Not quite sure where I would put that, but let's say out of this zone here, breaks out. Yes, it seeps back in, but it did not go below the previous swing low, guys. It set back in, went back up, creating another 43-month consolidation, broke out, and that served as important support later on. Look at that, retested it, fine. Retested it, went down below, so there was weakness, went down below this line, but it did not go below, much below this bigger base right here. Now it's starting to create another bigger formation, 179-month, within it 85-month dual base, and you see that that base created the move, which helped it complete its reverse symmetry move. And look, for platinum, we could expect it to do pretty much what oil did right here, what it did previously here. So eventually it will do something like oil did, do what copper did, see it went all the way back up here, and what sugar did also, right? Base within a bigger base helps it try to reach that neckline up here. Oil did drop all the way back down below here. So here it did not break from this base. So it's kind of like, at that stage, it was kind of like platinum, right? It's still at risk of dropping low. So maybe, yeah, maybe platinum can do this type of move where until it closes above this consolidation base, it could explode. But it didn't close below the low of, Jesus, it did go pretty low. It went below the low of 2002. So is that an exception to the rule? That was pretty violent wick all the way down. But you'll notice it happened for oil. But for in March of 2020, even all the other ones, platinum, a little more vulnerable, copper didn't even do that, sugar didn't do that. So this is, yeah, it adds possibility of this type of move, but only if the consolidation pattern has not broken out of, right? It's vulnerable to go down. And I'll show you why that is important for a gold chart. All right, almost done, guys. Stick with me, man. Stick with me. 16 minutes. Ah. Okay, so here's silver. All right, here's a halfway pattern. Still 45-month consolidation right here. This base explode, creating this line right here. Support, support. Now it broke down. Not a super duper important base like I'm going to show you that it did later. Here, 216-month base. And then within it, you had 32 base down here, which created an explosion upwards. Now we're starting to define that breakout line, wherever it may land. Here's another base higher. See, right? That next base, 40-month base was higher, and it did not seep that low. Like it could seep in within that previous base, but it did not go below it. Higher low. And now that's going to help launch the next W, right? Hoop up, hoop down, and that base launches the next move to the more important breakout line. So now you have two bases within a bigger base, creating a breakout, which is super meaningful at this stage. 2008 crisis, it did not go below it stayed above that line, that huge base. It stayed above, did not go below or seep in that base or go below that base. It stayed above, guys. Remember that. Where we are today, 131 month base, bigger base, which is not broken out of yet. Here we have a 70-month base, which did break out. So right now, this is more bullish. This is like, it's like platinum didn't do it. It's like oil completing its space, reverse symmetry move. It's like copper doing that move here, trying to hit that horizontal, the next breakout line of that bigger base. It's like sugar trying to attempt to go at it. Silver did it. It went all the way at that bigger base, guys. So right now, this is 70 months of support. So that line, that breakout was meaningful. So can it seep in, go within that pattern? Yes. But you have to highly expect that thing is not going to seep that much lower in, guys. Just like once it broke out here, did it seep just a little bit below, stayed above? Once it broke out here, see, did not even seep below. So to expect silver to go here below the lows of that base is highly unlikely, especially because here, this is the market telling you this base, 70 months base was a breakout, was very important, guys. So it still didn't have this bigger base breakout. So that's when you see what gold did, then you'll understand why the dynamics, the probabilities of gold going back to those lows are much lower than you would think. Okay, here it is. Here's the gold chart. Patrick, finally, couldn't you start with the gold chart? Okay, so here, that consolidation period in the 70s, 80 bars, 53 months, exploded up. And gold's so powerful. Your purchasing power is getting so demolished that it didn't even come close years later of ever getting tested. So higher lows. And then after that, gold, as long as it doesn't break out above a huge base, then until it's vulnerable to go down until it hits the next confirmed base that broke out. So once you get a confirmed base that broke out, that resistance is now support. So right here, yeah, of course it could go back down because right now it hasn't broken out those swing highs, guys, where they are essentially the echo bubble going down. The echo bubble is hitting that previous support, now it's resistance. Now you're starting to define the next box, right? The huge rectangle. So right, I see you can't get back above that. You're not ready yet. So here I have a conservative box, bigger pattern, 191 months. She's 5,800 days. It's morphing into existence. Then after that goes down my reverse symmetry move. You guys, you see it now, 52-month base. And once you break out, this has become support. And what do you get? You get a reverse symmetry move. And then you get another rush at the breakout line. And if you close above, then that becomes support. So that previous resistance becomes support. So now you have the dual smaller base within a bigger base. And once you break out that is meaningful. Let's move on. Here's another one, smaller consolidation pattern. I marked it, but I don't think we'll ever get there, but it's still there. So that's a 19-month consolidation, which is creating, that's wall, previous support, previous resistance, turn support. Sorry, guys, that's my dyslexia. So gold goes up, and wait for it, guys, because the next chart after that, I'll show you even more evidence. I'm going to go all in on this video to make sure that we grab everything. I'll show you why this, also the context of where this is happening and when this is happening is totally different than when the times that gold severely pulled back. All right, so check this out, huge base. So now you've seen these before, right? You drop in, test one, twice, here once, twice, drops in, then you're creating a smaller base within that bigger base to try to carve out the bottom. And this 73 months, guys, huge base. It's huge. Patrick, how come you can't do the math in your head? 6 year base, guys. So this is getting important. 6-year base, you broke out in June of 2019. So now that 1350 is important support. So it's previous resistance turns support. It's a wall. It's these ones. And you've seen over time, guys, when you've had these, you don't even come close to testing them. And if you like, you just don't. And maybe on the other instruments which track more economy or recovery in the US equities, gold tracks the loss of your purchasing power. No matter what happens, that's what it's tracking. And that's why gold is a very beautiful looking chart. So now look at what gold did also. It broke out above this box right here. So did I get greedy in my box? Is the box higher? Are we defining? Maybe in hindsight we'll realize that we haven't broken out that bigger box. But we assume that we did. Then now this 1800 is previous resistance turns support. Yes, you could seep in. So if it's uber weakness, you could seep a little bit below that. But you can't expect it to go below. Could go down here, stay above that 1350, but to get back down through 1350 and really go in there and really drop and then just rip through that and think it's going to go through 1350 all the way to 1000, which the market has shown to you that was a critical base, and try to reach. Look, I highlighted this 880, 860 to, okay, maybe that's too low, but like this zone here where people are like aiming that, you're totally disregarding this base. It's like you have to wait until this falters to even think about going through that, because I haven't seen any cases where these 6-7 year bases have been overridden. Like, yeah, okay, seep through 1350, whatever, but to go all the way down here, it's just insane. It's like we're really totally not there yet for that, especially because now you've broken out of this bigger base. If we haven't, then we're in the case of silver, US oil. But US oil has not went after it closed out of this base here, this 85-month base. It's hasn't went back down here, right? This was before this smaller base was confirmed, right? Still hasn't confirmed that base. Platinum, HG confirmed that base, so we'll have to wait and see if it goes all the way back down here. And sugar has shown us that once it closes above these 8-year bases, it doesn't visit them again. So that's a super long shot, guys. But now I'll add my my smoking gun. It's the gold to SPX ratio. All right, so gold, when it pulled back in 2013, it did that huge move down, guys. This huge, this move down here, all the way down here. Because to go all the way back down to, let me get my measuring tool, price range. For it to go down all the way from even here, all the way here, that's another 50% move, guys. 50% move. And gold here did what? It did 42% in a bear market. And I'll show you why. It did 42% here. It did here. It did 50%, 56%. And I'll show you what was the context of that, why it did 56%. And right here, it did 40%. So that's 50% move. So you got to be in a macro situation where something is happening with the capital flows. So let's look at the gold to SPX ratio. Look at where the ratio was. Okay, this is a PNF chart, so this is tricky. I'll do it here. Here, when it dropped 2000, yeah, when it started dropping a lot. Okay, I'll put this line here. Look where the ratio was. Here, 1980. When gold severely started drop those hard drops, look where the ratio was, guys. It was so much in favor. The SPX was so much undervalued because I'm measuring it in gold. It was at super lows, guys. And that's when gold was susceptible of taking a huge beating. Here, even here in 2011, 13, I'll bring it up here. Gold was susceptible of getting a hard retrace as it was hitting this support here versus the SPX. So you need a suction, an evacuation of capital flows from gold in the SPX for gold to severely drop that 50% move down. Like that means all the money's sucking out of gold and it's going to the SPX. And look at the ratio where it is today, guys. It's at Nifty 60, Nifty 50 dot bubble. It's higher than the 2029 crash. It's high. It's all like nothing's going to beat probably the .com bubble, but it's in this nosebleed section. So the ratio is not down here, or even 2013. It's much higher. And look at these lines. Is this my? Yeah. Gold has not broken down versus the SPX. SPX has not broken down versus gold yet, so it's not 100% out of the realm of possibility, but the momentum is slowing down in favor of gold. Here's a breakdown. Here it's a bounce. So now it's less and less steep angles. You see, can't really do a higher high right here. So that's a slowing of momentum. So we haven't had a clear break like this here, like here. But I'll show you the final chart, guys, to show you why this is so precarious for US equities. They're susceptible of going down 40, 50% nominally, way more than gold is to reach that sub 900 target. This is SPX measured in PPI. So PPI is a producer price index. It's a truer measure of inflation. It's producer input costs. This stuff, there's no hedonics. So look at that, guys. This is the 1920s SPX outperforming PPI. 1, 2, 3, 4. Beautiful touches. 5. Breakdown. Game over. You got I don't know how many years. 300 months until that thing. 268 months before that thing now creates a new breakout line in favor of SPX. It breaks out, and then you go long SPX instead of commodities. Goes up, up, up. Clean. See the momentum slowing down right here. Shallower and shallower bounces until it breaks below that rising trend line. Well, what was that? That was 1969. That's when US equities topped out versus producer price index or inflation, and that's when gold and silver went ballistic, and then you're long that. So it goes down. Then it went down for another 186 months until a new trend line. Not quite sure where to put that, but a new pivot line or breakout line was formed, touches from above, here, below. Then you break out, and then it's confirmed. You definitely have to be in favor. Oh, maybe it's here. Definitely in favor of US equities as SPX is outperforming the producer price index. And then off it goes. Then you're long SPX, 1 touch, 2, 3, 4. Can't regain new highs, breaks down below. That's all she wrote, 2003. So now you have to wait another 157 months until that thing breaks back up to the upside in 2012. That was the gold top. That's when gold dropped 50% down to those 2015 lows. But look what happened, guys, just recently. 1, 2, 3, 4. Like I'm not quite sure where you put that line, but that's a meaningful breakdown, guys. So this is it. This is the equivalent of being back in 2002, right after the .com bubble burst. Same thing as being in 1930 when the stock market crashed. Same thing here, 1969. So this is leading gold, unless you classify that this line was the breakdown line, and this is just an attempt to regain that line, but you're losing momentum and it turns over, right? This is telling you that the odds are of the macro flows of money are going into whatever, for whatever reason, because of inflation, growth stocks, they can't get the PDEs don't work anymore, whatever, the most multipliers, whatever fundamental guys look at. They're just shifting right now. They just changed. Yes, of course, it could be a bounce like this and go sideways, but nominally, it's going to start defining some resistance, guys. So this line here, I'm not quite sure. That's why I put it like I guesstimated it based on the previous lines. This will know how high it goes once we see that bounce here years later, or like wherever that's going to be. We'll find out, resistance, never straight line. So you could bounce here, bounce there, bounce there. Will it go lower? Will it break up? Maybe it's going to come in and retest here and then continue back up. But until that happens, now you're in what I call a sleep mode. So this is the wake up line. This is the sleep mode line. Below that, there's a shift. You're not there anymore. It doesn't mean it's going to totally break down, but until it regains that line, you're at risk of it dropping slowly, going sideways, dropping hard. You're at risk, guys, because if this critical rising trend line has been broken, that momentum defined by that incline is gone, guys. It's just gone. So, guys, that was a long rant, but that is pretty much why. And guys, if you want to challenge this, please do. That is why $900 gold is just doesn't fit. It just doesn't fit, guys. Like, I want to be unbiased. It's the weight of evidence makes it super hard for me to believe that. Look, somebody's gotta explain to me. Is it a spike? What are you imagining? You draw it. I need to see a chart, guys, a drawing. Show me a drawing, a roadmap of why you can just slice through butter through there, like. Or show me, maybe you want to go the Japanese way. Maybe this is what you want to show me. It's going to be a slow grind over years and years and years, and then we'll be able to go through that 1350. But right now, when I see that, SPX breaking down versus PPIA, uh, that's it, man. I'm speechless, guys. All right, guys. Hope you made sense of this, but you got to take a step back, look at the weight of evidence, and keep it clear and level-headed, guys. Thanks for watching. Take care, guys.